Welcome, dear traders. You're watching a recap of the Asian session. Global equity markets have seen a slight revival in risk sentiment over the past 24 hours. Stocks rallied as the US government reached a deal to raise the debt ceiling. However, as it was a holiday in the United States and Europe, including the UK, trading was generally subdued. The agreement between the US President and the Speaker of the Congress is just the initial stage. Meanwhile, approval of that 99-page bill in the House and Senate may face roadblocks. US lawmakers are expected to debate and vote on the document on Wednesday. Meanwhile, US Treasury Secretary Janet Yellen warns that the government may face default in the debt ceiling is not raised by June 5. Therefore, there will be uncertainty about an impending crisis until Congress passes the legislation. In the meantime, stocks and the currencies are likely to see spikes of volatility. As for the US dollar, the prospects of a quick resolution of the US government debt crisis have diminished its safe haven appeal. On the other hand, the growing expectations of interest rate hikes by the Fed are supporting the greenback against its counterparts in the G6 basket. As a result, the US dollar index climbed to 104.50 on the Tuesday, the highest level in 10 weeks. Against the backdrop of uncertainty and a looming US default, the greenback remains resilient. On a Tuesday, the US currency was moving in the green price corridor of 104.09 and 104.51 in the Asian session. The greenback is expected to rise by 2.5% in months. That will certainly confirm its status as the almighty currency, even against the background of the recent sell-offs. In the short term, the greenback is likely to remain bullish, breaking above 104.50. USDX will reflect an intensification of buying activity. This may accelerate the uptrend to the resistance levels of 104.70 and 105.5. Today, the US dollar fell sharply against the Japanese currency, almost 240, as the bearish momentum intensified. The pair's chart has already shown high volatility in the Asian session, as we warned at the beginning of our review. In addition, long positions in the pair reduced as the dollar index became less attractive. US Treasury yields also fell sharply. As a result, the yield-sensitive yen received some optimism. Investors received positive signs from the Bank of Japan after Governor Kazuo Ueda announced that the regulator planned to buy government bonds. The governor stressed that the Bank of Japan would patiently maintain its ultra-loose monetary policy as there was some distance to substantially achieving its 2% inflation target. Today, the yen will be driven by news from the US, the debt ceiling negotiations and economic data. In the Asian trade, the yen started the trading session in the range of 139.90 and 140.90 against the US dollar. At the same time, the Japanese currency is expected to strengthen. The antipode currencies also saw high volatility today. At the beginning of the Asian session, the Australian dollar sharply strengthened to 0.6550 on a sell-off of the greenback and the possible surge in a domestic inflation. However, the Aussie was then pulled sharply lower and settled in the range of 0.6503 and 0.6560. Meanwhile, the Australian currency may receive support from the CPI release on a Wednesday. In addition, inflation in Australia is expected to rise slightly. Tomorrow, investors will also focus on a speech by the head of the Reserve Bank of Australia, who will present his rate forecast. On the other hand, expectations of a further interest rate hikes by the Fed are strengthening the greenback against the Australian dollar. restraining the pair's rally slightly above 0.6540. The New Zealand dollar is trading within the range of 0.6027 and 0.6063 today. The currency started a consolidation at the end of the Asian session and traded in the area of 0.6050. Notably, the kiwi is falling against most of the major currencies. Against the US dollar, it remains at its lowest level in the last 6 months. Since New Zealand's economic activity is slowing down and the country's central bank may refrain from interest rate hikes, the bearish sentiment is likely to persist. And that's all for now. Hit the subscribe button and keep close tabs on the market developments with us. See you soon.